So how can we explain these exchange rate movements? Well, there's a lot of theories, and we want to touch them only slightly, with the exception of the covered interest rate parity condition, where we spend a lot of time on. In other economics class, I think you go deeper into them, especially into the PPP. Let's go through them step by step. Purchasing power just means how much power I've got to buy stuff, and parity means it's 1 for 1. So the simplest way to think of that one is the following. Let's say the Australian dollar and the US dollar are sitting, $1 is buying $1 US. And let's say in the US cars cost $20,000 and in Australia they cost $30,000. And let's forget about left hand and right hand steering. Where do people want to buy their cars then? Everybody wants to buy their cars in the US. So that would mean lots and lots of cars will be bought from the US. And that also means in order to buy them from the US, which currency do we need? US dollars. So everybody is buying US dollars. If everybody is buying US dollars, how do they pay for it? Australian dollars. So there's a lot of demand for US dollars, a lot of supply of Australian dollars. What's happening to the value of the Australian dollar? Depreciates. And that happens until the cars cost roughly the same in the two different currencies. So that's the basic idea of purchasing power parity. So it's, in the very, very long run, you would think it's not possible that one country is always way cheaper than all the other countries, because then the whole world would go shopping in that country and its exchange rate would appreciate. And the other way around too. It's impossible that one country is always way more expensive than all the other countries, because then their consumers would start importing everything, which means that they're selling their own currency, which then depreciates. That's the basic idea of purchasing power parity, so that the exchange rate adjusts so that shopping in different countries costs the same. Makes sense. Turns out doesn't work in reality whatsoever. So there are certain countries that stay cheaper for 20 years or 30 years. And there are other countries that stay more expensive than other countries for a very long time too. So it's not really good to predict where the exchange rate will go next week or next year. Right, so if you're speculating in exchange rates, you can look at the purchasing power parity, which means the theoretical exchange rate it should be, but there's no guarantee that the real exchange rate is going there anytime soon. So that's one theory. Now, why doesn't that theory work that well? I think a good way to think of that one is to look at what happens in foreign exchange markets. So we've got here the daily turnover in Australian foreign exchange markets. So this is how much buying and selling of Australian dollar and other currencies happens within Australia in billions of US dollars measured. So let's say if I'm buying, for example, now Australian dollar worth $1 billion US dollars, one of those numbers would go up by 1 billion. Right. That's what's meant by turnover. Now let's look at these numbers. Daily turnover April 2013. One single day, 200 billion. Exports in the whole year 2014, 326 billion. So the trade of foreign exchange for 2 single days, the trade turnover for 2 single days, would be more than we need to trade in exchange rates to pay for our exports for the whole year. Now, what do I want to say with this one? All these trades here, do they happen for importing and exporting? Can't be, right? That's way too much. All the money and foreign exchange trading that we need for exporting and importing would be like tiny down here if we do it daily. Right? It would be a small number. So something else is happening here. There's a lot of trading of exchange rates, of currencies happening that have nothing to do with trading. At least not real trading. Now we can also look at who's trading. Most of it is banks and financial institutions between themselves. The trade is also over the counter, which basically means that we are not going to a centralized market where everybody's meeting, but it's kind of, I call another bank and say, listen, I want to have so and so many $1 million or sell so and so many $1 million. So it's kind of one-on-one. Nowadays it's done often by computer, but the principle is the same. Your counterparty is not the market, but another institution. which kind of currencies are traded. So most of it is Australian dollar, US dollars, but we can also see here lots of other currencies are traded in Australia as well. Right? And that doesn't make much sense. I mean, if we are exporting and importing, why would we swap around US dollars to Japanese yen as Australian exporter and importer? We don't need these currency pairs. Right? But financial institutions might need them because they might do a lot of arbitrage business or partially speculation in foreign exchange markets. And it's the direction I want to head to. So also Australia is somewhat overrepresented in worldwide trading and exchange rates in currencies. And the reason for that one is our timing. If you want to buy Boeing shares, in which markets do you have to buy them? Can you buy Boeing shares in Australia at the Australian Stock Exchange? Or German Stock Exchange? No, you have to go to the US. If you want to buy Deutsche Bank shares, where do you usually go then? Germany. They're actually listed in New York too, but let's stick to it. Germany. If you want to trade Westpac shares, Australia. But if you want to buy US dollars, where can you do that? Everywhere. So currencies can be traded everywhere. There's no one spot market where the currency is traded. And that's different to shares. And that's the reason why currencies can be traded for 24 hours. So you just move from country to country. And you can trade 24 hours. You don't have to wait for trading times. And in theory, people could trade in New York in the middle of the night, just via computer in the Australian market, but that's a bit inconvenient. So what they often do is they simply have like a branch in Australia too. Right? Or there's basically people in Australia that trade a lot in currencies just because the other markets are closed at that time. Right? So the market is moving basically with the sun so that people don't have to work at night time. That's the reason why Australia is so important in the currency market too. Good, turnover by different type of contracts. So we have spot contracts, that's what happens immediately. Outright spots, the blue ones here. Then we have forward contracts and foreign exchange swaps. Now I don't want to talk much about swaps, so I'll touch on them slightly only today. Later when we talk about banking, we can talk more about them. And options we talk a little bit next time about too. Now the message here is so forward and also swaps, very important. So again, this is done for financial reasons. Now, I said beforehand, most of the turnover is actually not done for import and exports, but for some kind of other reason. And the main reason is that we're investing in different countries because interest rates are different. So currently the interest rates in Australia, for example, is sitting at, I think, 3%. Depends upon how long you want to invest. In the US, they are roughly sitting at 1%. So it seems that it might be attractive to invest in Australia. So there's lots of financial flows happening for these kinds of investments. So interest rates are very, very important for explaining what's going on in the currency markets. Now we have something called the uncovered interest rate parity condition, and that basically says, just take my example from beforehand. Australia, I make round numbers, is paying you 3% interest. The US is paying you 1% interest. Where do most of the people in the world want to invest? If the exchange rate were fixed. Australia is much better than the US. But the exchange rate is of course not fixed. It's fluctuating over time. Now because Australia is giving you 2% more in return on your savings account, when would the flow of money towards Australia stop? What does the market must expect of the Australian dollar value to happen over the next year? Let's say if the value is constant, everybody wants to invest in Australia. If we expect the Australian dollar to appreciate, do more people want to invest in Australia now or less? That was a trick question. If it's appreciating, the Australian dollar is gaining in additional value. So you get 3%, 2% more than in the US, plus you get additional gains from the appreciation, which makes it even more attractive. Must depreciate, right? The Australian dollar must lose. And let's take a rough guess by how much. So Australia is paying you 2% more on the savings account. If the Australian dollar is expected to lose 1%, is it still better to invest in Australia? Yes, so money is still flowing. If the Australian dollar is expected to lose 2%, then it's the same. then the money stops flowing. And if the Australian dollar would be expected to lose 3%, the money would flow the other direction. So that's what's basically the idea of the uncovered interest rate parity condition. The expected exchange rate changes exactly offsetting the difference in interest rates. So if the interest rates are 5% higher in one country over the next year, you shall expect that currency of the other country to depreciate by 5% to eat up that interest rate differential. Otherwise, it would be money on the street and everybody would invest in there. So interest rate parity condition basically means now you earn the same amount in both countries. In the US you earn 1%, in Australia you earn 3% minus 2% depreciation, also 1%. Thinking around the corner question, if you're an Australian and you invest in the US and the Australian dollar is depreciating by 2%, okay, what's your return as an Australian? I help you a bit, it automatically means that the US dollar is appreciating by 2%, so you get 1% US dollar return, plus the gain 2% of the exchange rate change. That means that you as an Australian, if the money comes back, actually earned 3% again. So Australians in this example always earn 3%, and Americans always earn 1%. And if you go across borders, it doesn't change anything, because whatever you gain in interest, you lose in depreciation. Whatever you lose in interest, you would gain in appreciation. So that's the idea of parity. Uncovered it is because we have no insurance against foreign exchange rate fluctuations. And it turns out if you look at the data, this theory doesn't really hold in the real world either. Which brings us over to the next one, the covered interest rate parity condition. So there you invest in another country, but at the same time you buy insurance against foreign exchange rate fluctuation. And that insurance I can call forward rate. So you fix your rate that you will get next year with another counterparty. That's the direction we're going now. And the covered interest rate parity condition is super important because that one does always hold, not only in theory, but in practice in the real world too.